the champagne sits chilling on ice. In just a few short hours, approximately 1 billion people across the globe will gather around their screens to watch the iconic ball drop in Times Square, singing and celebrating as if the world isn't burning around them. Let them have their party tonight. Let them cling to their blissful ignorance for these final precious hours. Because while they're clinking their crystal glasses and making their hollow resolutions, the massive vault doors of the global financial system are slamming shut with a deafening finality. It is December 31st, 2025, and I want to be absolutely clear about why I'm here. I'm not here to wish you a happy new year or spread cheerful holiday greetings. I'm here to deliver what may be the final warning before everything changes forever. Take a hard look at what happened just yesterday. The LBMA website mysteriously went dark without explanation. Australian customs authorities suddenly blocked silver shipments at their borders. The carefully orchestrated $70 bear trap that the bank set up failed spectacularly as physical buyers around the world aggressively swallowed every single ounce that the banks desperately threw at them, trying to suppress the price. But here's the critical truth that nobody in the mainstream media is telling you: what happens tonight at exactly midnight. Beijing time makes all of yesterday's dramatic events look like nothing more than a minor paper cut before a fatal sword wound. While the Western world drinks champagne and celebrates mindlessly, China is methodically executing the most significant and transformative change to the global metals market that we've seen in 50 years. The rumors that have been circulating in underground markets are now confirmed beyond any doubt. The timeline has been set in stone. In this emergency broadcast, I'm going to show you with absolute precision exactly how China's controversial 44-company export lockdown mechanism actually works behind the scenes. I'm going to place you directly in the shoes of a desperate industrial buyer who has just lost their primary supplier overnight. I'm going to provide you with specific, actionable price targets based on rigorous analysis. And most importantly, I'm going to deliver the critical 24-hour survival checklist that you need to execute before dealers reprice everything tomorrow morning. That $74 price you're seeing on your screen right now, it's nothing but a ghost, a phantom of a market that no longer exists. This is the story of the night they locked the vault forever. While the Western world casually sips champagne and celebrates another year passing without a care in the world, China is methodically and deliberately executing what will be remembered as the most significant and transformative change to the global metals market that we have witnessed in the last 50 years. The persistent rumors that have been circulating through underground trading networks and whispered in closed-door meetings are now officially confirmed beyond any shadow of doubt. The timeline has been irreversibly set in motion. There is no turning back from what begins tonight. In this emergency broadcast that I've prepared for you, I'm going to meticulously show you exactly how China's controversial and highly restrictive 44-company export lockdown mechanism actually functions behind the scenes. I will break down every single component of this system so you understand precisely what is happening. I'm going to place you directly into the desperate shoes of an industrial buyer who has just lost their primary and most reliable supplier overnight without warning. You will feel the panic, the pressure, and the impossible decisions they now face. I'm going to provide you with specific, carefully calculated price targets based on rigorous market analysis and historical precedent. And most critically, I'm going to deliver the essential 24-hour survival checklist that you absolutely must execute before dealers across the country reprice everything tomorrow morning when they wake up and realize what has happened. That $74 price per ounce that you're currently seeing displayed on your screen right now, it's nothing but a ghost, a phantom number, a relic of a market structure that no longer exists in reality. It's a hologram of a dead system that continues to flash on screens even though the underlying mechanism has been completely destroyed. This is the untold story of the historic night when they permanently locked the vault and threw away the key forever. What you're about to witness is not just another market correction or a temporary supply disruption that will resolve itself in a few weeks. This is a fundamental restructuring of how silver moves around the planet. This is China declaring that the rules of the game have changed permanently. The free flow of silver that has existed for decades, where metal moved seamlessly from London to Shanghai to New York and back again, is being terminated tonight at midnight Beijing time. Tomorrow morning, the world wakes up to a completely new reality where Western paper promises and Eastern physical metal exist in two separate universes with two separate prices, and the gap between them will only widen with each passing day. Before we proceed any further into the technical details and market mechanics, I need you to take a moment and truly understand what this monumental shift means for you on a deeply personal level. This isn't just about abstract market forces or geopolitical maneuvering happening somewhere far away. This directly impacts your wealth, your security, and your future in ways you may not have fully comprehended yet. If you are currently holding physical silver in your possession, whether it's stored in your personal safe, buried in your backyard, or locked away in a secure vault facility, you are about to own a critical resource that is being actively and aggressively nationalized by the world's second-largest economy. Let that sink in for a moment. Your ounces are not simply rising in dollar terms like a normal commodity experiencing a bull market. They are fundamentally transforming into something far more valuable and strategically important. They are becoming geopolitically strategic assets that nations are fighting to control and hoard for themselves. The exact same silver that sits quietly in your safe right now is the identical silver that Tesla desperately cannot buy for their electric vehicle production lines. It's the same silver that Samsung cannot source for their smartphone manufacturing. It's the same silver that the United States military urgently needs for precision guidance systems in their advanced weaponry. You need to understand this clearly. You are not holding a simple commodity that fluctuates with industrial demand. You are holding what I call a siege asset, something that becomes exponentially more valuable when supply lines are cut and nations go to war over resources. If you're sitting on the sidelines waiting to buy silver at a better price, thinking you'll catch a dip next week or next month, I need to tell you the brutal truth. The window of opportunity you think exists simply does not exist anymore. It's an illusion based on old market conditions that evaporated at midnight. After the clock strikes 12 tonight Beijing time, every single ounce of silver remaining in the Western Hemisphere becomes contested territory. It becomes the subject of fierce competition between industrial buyers, governments, and investors, who all suddenly realize that supply has been permanently cut off from the East. Dealers across the country will reprice their inventory by tomorrow morning when they check the overnight markets and see what has happened. Yesterday's modest $5 premiums over spot price will transform into $15 premiums by next week as panic sets in. By February, you'll be looking at $25 premiums or higher as the reality of the supply shortage becomes undeniable. The comfortable world where you could casually buy silver at a small premium whenever you felt like it is ending tonight. Tomorrow begins a new era of scarcity, competition, and dramatically higher prices across the board. If you are currently holding paper silver in any of its various forms, whether that's SLV exchange-traded funds, silver futures contracts, or unallocated accounts with banks or brokerages, you need to understand with absolute clarity that you are holding nothing more than a claim on a system that has just catastrophically lost its largest and most critical supplier. This is not hyperbole or fear-mongering. This is the stark mathematical reality of the situation you now find yourself in. Here's the fundamental question you need to ask yourself right now, tonight, before midnight strikes, when the New York market displays a price of $74 per ounce, but the Shanghai market simultaneously shows $83 per ounce for the exact same metal. Which number will your ETF actually honor when you attempt to redeem your shares for physical delivery? Which price will the futures exchange recognize when you try to stand for delivery? The uncomfortable truth is that you will almost certainly receive the lower Western paper price, while physical metal trades at the higher Eastern price, and you will have absolutely no recourse. This is not merely a trading event that will resolve itself in a few days or weeks. This is not a temporary dislocation in pricing that arbitrageurs will quickly eliminate. This is what I call a resource bifurcation, a permanent splitting of the market into two completely separate systems that operate under entirely different rules. One system trades paper, promises backed by nothing but the creditworthiness of counterparties. The other system trades physical metal that can actually be delivered and used. These two systems are diverging tonight, and the gap between them will only grow wider with each passing day. By tomorrow morning when markets open, you will face a binary choice with no middle ground. You either own actual physical metal that you can hold in your hands, or you own a promise that fundamentally cannot be kept. You own real silver, or you own a legal claim on a system that has just lost access to its primary source of supply. Those paper contracts you hold, those ETF shares you bought thinking they were as good as physical, they are backed by silver that largely sits in vaults in London and New York, but those vaults were continuously replenished by flows from China and other Eastern sources. What happens when those flows stop permanently? In part 2 of this emergency broadcast, I'm taking you deep inside the 44-company choke point mechanism that China has constructed. I'm going to show you the exact companies involved and how this system operates in practice. The numbers and percentages I'm about to reveal will absolutely shock you and make you question everything you thought you knew about global silver markets. Stay tuned, because what comes next changes everything. If you are just joining us now, let me completely reset the conversation and bring you up to speed on what is happening tonight. China is implementing what they are officially calling a strategic resource preservation mandate, and this mandate becomes effective at exactly midnight tonight Beijing time. I need you to understand precisely what this means, because the government and mainstream media will try to downplay the significance of what's occurring. This is not a tariff that adds a percentage cost to exports. This is not a tax that can be calculated and absorbed into pricing models. This is a hard close, a complete shutdown of the free flow of silver out of China. For the past 20 years, China has functioned as the world's factory, the manufacturing powerhouse that produced everything from electronics to solar panels. The system worked like this. They imported raw silver from mines around the world, transformed it into finished products like solar panels and smartphones, then shipped those products back to Western consumers. The metal flowed freely across borders in both directions. International supply chains were smooth and predictable. Everyone benefited from this arrangement, or so it seemed. But something fundamental changed in China's strategic calculations. They sat down with their economists and resource planners and looked carefully at the numbers. They examined the structural deficit in global silver markets, that massive 1.1 billion ounce shortage between annual mine supply and total industrial demand. They ran the projections forward and came to an inescapable conclusion. There is simply not enough silver for everyone who needs it. The math doesn't work. Someone is going to be left without adequate supply, and China decided it will not be them. The new rule is brutally simple. Made in China stays in China. Silver that enters Chinese borders for processing will never leave again. It will be consumed domestically in China's massive solar industry, their electronics manufacturing, and whatever strategic reserves the government is building. The mainstream media outlets will call this merely a licensing update or regulatory reform. They will carefully explain that China has not actually banned silver exports outright, but has simply regulated them more carefully through a new approval process. Do not fall for these semantic word games and bureaucratic language designed to obscure the truth. The Ministry of Commerce in Beijing has released the official approved exporter list for the year 2026. This list determines which companies have legal authorization to move silver across China's borders. So how many companies made this exclusive list in a nation of 1.4 billion people with thousands of refiners and suppliers? Exactly 44 companies. Just 44 approved entities in the entire country. This is not regulation in any normal sense of the word. This is a tourniquet applied to stop the bleeding of resources out of the country. The Ministry of Commerce in Beijing has officially released the approved exporter list for the calendar year 2026, and this list will determine the future of global silver flows for the foreseeable future. This document represents the complete catalog of companies that have legal authorization to move silver across China's borders. So let me ask you the critical question: how many companies actually made this exclusive list? In a massive nation of 1.4 billion people, with literally thousands of refiners, processors, suppliers, and manufacturing companies that handle silver, how many received approval? The answer is exactly 44 companies. Just 44 approved entities in the entire country have the legal right to export silver. Let that number sink in for a moment. 44 companies out of thousands. This is not regulation in any conventional sense of the word. This is not the government establishing reasonable guidelines and standards that companies must meet. This is a tourniquet, a deliberate choking off of supply designed to keep silver trapped inside China's borders. The mechanism is brilliant in its simplicity and devastating in its effectiveness. Here's exactly how this system works in practice, and I want you to imagine yourself in this scenario. Let's say you are Apple Inc., one of the largest technology companies in the world. You need significant quantities of silver for the production of the upcoming iPhone 18. Silver is essential for the electrical contacts, circuitry, and various components. You've worked with a reliable supplier in Shenzhen for years. You call him to place your standard order, and he delivers 3 devastating words: cannot ship, not approved. He explains that he's not on the approved list of 44 companies. His refinery, which has operated successfully for decades and shipped millions of ounces internationally, is now completely locked out of the export market. He tells you that your only option is to contact one of the 44 approved companies and hope they can help you. So you start making calls to Beijing. Now let's examine who these 44 companies actually are, because this reveals everything about China's true intentions. These are not independent private companies operating in a free market. These are state-owned enterprises, companies that are directly or indirectly controlled by the Chinese government. They report to Beijing. They follow orders from Communist Party officials. They operate according to strategic national priorities, not market forces. When you finally reach one of these approved companies, let's say China National Gold Group, they quote you $95 per ounce. That's $21 above the spot price you see on Western exchanges. And that's if they even have inventory available, which they probably don't because they're prioritizing domestic manufacturers who are producing solar panels and electronics for China's internal consumption. The silver stays in China, serving Chinese strategic interests, while you're left scrambling for supply. But here's where we discover the real choke point in this entire system, the mechanism that gives Beijing absolute control over every ounce of silver that attempts to leave Chinese territory. Before any of these 44 approved companies can ship a single ounce of silver across the border, they must file a formal export application with the government. This application doesn't go to some low-level bureaucrat or automated approval system. It goes directly to a desk in Beijing where a Communist Party official reviews it personally. This official sits in his office and asks himself a very simple but consequential question. Does the party want this silver leaving China right now? Or do we keep it for our massive solar farm projects and strategic reserve stockpiles? What serves China's interests better? And then he makes his decision. He stamps the application approved or denied based entirely on political and strategic considerations, not market forces or business relationships. The approval process is completely opaque, with no published standards or timelines. The 44 company list that everyone is focused on is not really a door providing access to Chinese silver. It's a vault door with a 50-digit combination lock. Beijing holds the only code, and they can change that code whenever they want. Even if you're one of the approved 44 companies, you still need government approval for every single shipment. The companies are just gatekeepers, but the party controls the gates. There's a second mechanism that has operated in the shadows for decades, and understanding what happens to it reveals just how total this lockdown really is. I'm talking about the gray market. For the past 20 years or more, small refiners and trading companies have shipped millions of ounces of silver through Hong Kong, disguising it as jewelry components, industrial parts, or other innocuous categories on customs forms. This shadow network moved enormous quantities of metal under the radar of official statistics. It was the escape hatch, the pressure relief valve that kept silver flowing even when official channels were restricted. As of midnight tonight, that escape hatch is being permanently welded shut. The new mandate includes explicit criminal prosecution for unlicensed export of silver. We're not talking about fines or administrative penalties. We're talking about prison time for executives, confiscation of assets, and the complete destruction of companies caught violating the rules. The small players who operated in the gray market are completely done. They cannot take that risk. The river of silver that flowed through these unofficial channels has become a tightly controlled faucet. The Communist Party now controls the valve on that faucet completely, and they have just announced to the world that they are not sharing. The free flow of silver from east to west is over. In part 3, I'm putting you directly in the shoes of an industrial buyer who is watching their supply chain vanish in real time. This panic, this existential fear, is exactly what drives the price from current levels to $100 and beyond. Stay tuned, because this is where theory becomes reality. Let me put you in a highly specific scenario that is playing out right now at companies across the Western world. Imagine you are the procurement manager at First Solar, one of the largest solar panel manufacturers in the United States. You have binding contracts to deliver 100,000 solar panels to utilities in Texas by February 15th. These are not flexible deadlines, they're hard contractual obligations with massive financial penalties for late delivery. Each individual panel requires exactly 20 grams of silver paste for the photovoltaic cells and electrical contacts. When you do the math, you need 64,000 ounces of silver to fulfill this contract. Yesterday morning, everything seemed perfectly normal. You called your trusted supplier in Guangzhou, a company you've worked with successfully for 5 years. They quoted you $74 per ounce, which is the current spot price. Total cost, $4.7 million. The margins are tight on this contract, as they always are in the competitive solar industry, but the numbers work. You can deliver the panels, make a reasonable profit, and keep your workforce employed. Everything is on track. Today you call that same supplier to confirm the order and finalize shipping arrangements. The voice on the other end of the line says just 3 words that make your blood run cold. We cannot ship. You ask for clarification, hoping this is just a temporary logistics problem. He explains that his company is not on the approved list of 44 exporters. He cannot legally ship silver out of China anymore. He suggests you try contacting one of the 44 approved companies in Beijing. The call ends. Your supply chain has just collapsed. You spend your entire New Year's Eve frantically calling numbers in Beijing, while your family celebrates downstairs without you. After dozens of failed attempts, you finally reach someone at China National Gold Group, one of the approved state-owned enterprises. They quote you $95 per ounce, if they have inventory available, which they're not certain about. They're prioritizing domestic buyers, they explain. Chinese solar manufacturers get first priority. They'll call you back in 3 to 5 business days to let you know if they can help you. 3 to 5 business days. Your production line starts on January 6th. You have workers scheduled, equipment ready, and contractual deadlines that cannot be moved. Let me walk you through your options, none of which are good. Option 1. Pay the $95 per ounce. Your silver cost jumps from $4.7 million to $6.1 million. Your profit margin doesn't just shrink, it completely disappears. You'll lose money on every panel you produce. Option 2. Miss the deadline entirely. Pay $10 million in contractual penalties. Watch your stock price drop 15% when the news becomes public. Option 3. Shut down production completely. Lay off 200 workers right after the holidays. Destroy relationships with customers you've built over years. This exact scenario is happening right now tonight to procurement managers at every solar company, electronics manufacturer, and defense contractor that depends on Chinese silver supply. They're on the phone desperately seeking alternatives while their families count down to midnight downstairs. Let me provide you with compelling historical proof that what I'm predicting is not speculation or exaggeration, but a pattern that has played out before with devastating consequences for unprepared buyers. In the year 2010, China made a strategic decision to cut rare earth element exports by 40%. The Western world had become completely dependent on Chinese rare earths for everything from smartphones to military equipment to wind turbines. These elements were critical to modern technology, and China controlled over 95% of global supply. What happened next should serve as a perfect template for understanding what's about to happen with silver. Neodymium, one of the most important rare earth elements used in powerful magnets, went from $40 per kilogram to $400 per kilogram. That's a 10 times price increase in just 6 months. This wasn't because global demand suddenly increased tenfold. This wasn't because mines collapsed or natural disasters disrupted supply. The price exploded because supply was strategically nationalized by a government that decided to prioritize domestic use over exports. The pattern followed 4 predictable steps. Step 1. New regulations are announced that sound reasonable on paper. Step 2. The approval process for exports begins to slow down mysteriously. Applications sit on desks for weeks instead of days. Step 3. Approvals stop coming entirely, but the government never officially announces a ban. Step 4. The The internal price for domestic buyers stays relatively low and controlled, while the external price for international buyers explodes upward as panic and scarcity take hold. We are currently at step 1 with silver. By tomorrow morning, when markets open and industrial buyers start making phone calls, the two-price system will become absolutely undeniable. You'll see one price quoted in Shanghai for domestic Chinese buyers and a completely different, much higher price quoted for Western buyers desperately trying to secure supply. Based on this historical analysis and the current market structure, let me give you specific price targets with timelines. Target 1. By January 15th, just 2 weeks from now, the Shanghai premium over Western spot prices widens to between $15 and $20 per ounce. This means the real price that matters, the price you actually pay for deliverable metal, reaches $89 to $94 per ounce. Target 2. By the end of January, as industrial panic accelerates and companies realize their supply chains are permanently broken, the Eastern price hits $100 per ounce. Target 3. By the end of the first quarter, assuming this export ban holds firm and doesn't get reversed, we see $120 per ounce. These are not hype numbers pulled from thin air. This is not promotional exaggeration designed to generate clicks. This is pure arithmetic based on supply and demand fundamentals. When you remove over half of global refined silver supply from the market overnight, prices must adjust dramatically to ration the remaining supply among desperate buyers. In the final part of this broadcast, I'm giving you the complete survival checklist for the next 24 hours. Stay tuned. We have finally arrived at the conclusion of this emergency broadcast, and now it's time for action. We have methodically dissected the 44-company choke point mechanism that China has constructed. We have watched the gray market escape hatch get permanently welded shut. We have stood in the desperate shoes of the industrial buyer who is watching their supply chain vanish in real time. We have mapped out specific price targets based on historical precedent and mathematical analysis. Now, I'm going to give you your personal action plan for the next 24 hours. In just a few short hours, the ball will drop in Times Square. The world will cheer and celebrate. Champagne corks will pop. But you know the truth that they don't. When the clock strikes midnight Beijing time, the global silver market doesn't simply turn a page to a new chapter. It ends completely. The free-flowing market, where silver moved seamlessly from London to Shanghai to New York, is dead. That world is gone forever. Tomorrow morning, we all wake up in a fractured world with two completely separate silver markets operating under different rules. There will be a Western price for paper promises that nobody can actually deliver against, and there will be an Eastern price for physical metal that nobody can export from China. These two prices will diverge further with each passing day, and the gap between them represents the death of the unified global silver market. Here is your 24-hour checklist broken down by your current position. If you are holding physical silver right now, do absolutely nothing. Do not sell into this rally thinking you'll buy back cheaper later. Do not take profits and convert back into depreciating fiat dollars. You own a strategic asset that governments around the world are desperately trying to hoard for themselves. Ignore the COMEX price on your screen. It's irrelevant. Watch the Shanghai price instead. Watch your local dealer's premiums. When your coin shop charges $90 per ounce and your screen still shows $74, believe the coin shop. That's the real price. If you're waiting to buy and still sitting on the sidelines, understand that your window closes tomorrow morning. When dealers wake up, check the overnight Shanghai prices and see that premiums have widened dramatically. They will reprice their entire inventory immediately. If your local shop still has inventory available at yesterday's premiums, buy it right now tonight. No dip is coming to save you. The arbitrage opportunities that used to bring prices back together are dead because metal cannot flow from east to west anymore. If you are holding paper silver, SLV shares, futures contracts, or unallocated accounts, you need to audit your counterparty risk tonight before you sleep. Go read the prospectus carefully and search for terms like force majeure and cash settlement. If the fund declares market dislocation, they can settle your claims in cash at whatever price they choose. You might be holding at $80, get cashed out at $70, while physical metal trades at $100. This exact scenario happened with nickel in 2022. Silver is not immune to the same treatment. This is not a trade. This is a regime change. Welcome to the two-price world. Subscribe now